Hello, everyone. Welcome to our December USDA and National Farm Income Tax Group uh, webinar. We're excited to be here with you. A little bit of housekeeping before we get started. Just as a reminder, this is being recorded, and then it will be posted on the farmers.gov YouTube channel. We have farmers.gov/taxes is where all of the tax resources that our partners have created to help you navigate taxes and your USDA program payments live. And there is a YouTube channel as well for all of the previous tax webinars. This has been a really great resource for folks, so we encourage you to please go and explore those resources as well as visit ruraltax.org. If you have questions during this webinar, please put them in the Q&A, so we'll answer those at the end. My name's Sarah. I'm USDA's Beginning Farmer and Rancher Coordinator, and I'm here today with Adam Kantrovich and JC Hobbs from Clemson University and Oklahoma State, and they are going to talk to you about your year-end taxes and managing taxable income and tax strategies that might be relevant to your operation. So without further ado, I'm going to hand it over to them.
Thank you, Sarah. Thank you, Janet, that y'all don't see, but she's on the back side, along with Dr. Ruby Ward at Utah State as well. I am Adam Kantrovich. I am an extension specialist and director of the agribusiness program and Clemson Tax School here at Clemson. So JC and I are going to be talking to you for the next 45 minutes to an hour or so on managing your taxable income and taxation. And what I'm going to do is I'm actually going to shut off my video just to make sure we've got full bandwidth so we don't end up with any hiccups, because I know some folks have been having some bandwidth issues creating some jerkiness to the internet. So, ruraltax.org is a group that is managed by the National Farm Income Tax Extension Committee, and we have a website that we manage, ruraltax.org, and that is managed through Utah State University. And through this website, we have a number of publications. We also have some of the archived webinars, etc., that you can find some publications. It should be relatively easy to locate. And we've updated a number of our publications and videos and decision tools that can be found there and are quite usable. If you use this QR code, it's going to take you to some very specific publications and information on that particular website. We also work with USDA and have been working with USDA Farm Service Agency for quite a while, and you can see some of this information brought to you by USDA through a contract agreement, grant agreement at that particular number. And we have been working with Sarah and Janet for the last few years with regards to that. We are greatly appreciated because that's what helps fund some of these programs that you get to partake in, as well as some of the development of publications, decision tools, and other activities. We need to note that what we are talking about today is for educational purposes. It is not professional, legal, or tax advice specific to your unique situation. There are a number of reasons for that. Taxes in general can get quite cumbersome, and so we are really talking at a 10,000-foot view, and you need to meet with a tax professional to be able to go over how some of the parts of what we are going to talk about today can affect your very unique situation. So make sure you do have that trusted professional that you can work with locally. We start to move in this time of year. We're closing in very quickly to the end of the year now. We are about 20 days away from the end of the year. Usually we begin to take a look at tax planning and start looking at tax planning type topics really in the month of November, if not even a little bit before. So fall really is the time to begin to estimate what my taxes are going to look like for the close of the year. You really ought to be working with and consult your tax and business management professionals about this time, late October, all the way through the month of November, to meet with them, run some tax estimates, and begin to take a look at some planning opportunities that we can put into place prior to the end of that tax year. And so part of this planning, we need to begin to ask ourselves some questions. What should or can I do between now and the end of the year? What options may be available? And then figure out what my goals are to be able to help determine some of those options, with the basic idea is for tax management to prepare me for those discussions with my tax preparer at the end of the year. And then so I have an idea of what we're going to be looking like at the close of the year and into the new year when it comes time to begin to file my taxes. So, a couple of notes or rules of thumb. Farming, or Schedule F, is one part of an overall tax return. It is not the only tax return. And if we begin to take a look at, and we don't have time today to really go into all of the different forms and all of the different business structures that a farm can exist in, which may determine what tax forms we need to be looking at and considering. But for most individuals, sole proprietors, single member LLCs, etc., the Schedule F of the 1040, usually people refer to it as the 1040F, is going to be the main tax return, which is my profit and loss from farming activities. So deferring tax does not eliminate tax, but it can be a tax management tool, and we are going to talk briefly at various parts through the next hour or so, and you may hear that term of deferring of taxes. And it's really important to understand that it does not mean tax elimination or tax or lowering or decreasing my tax liability. It simply means I'm pushing the tax off. And then we need to take a look at, as a part of this larger process, what helps the family and the business thrive. And although many tax professionals, and sometimes us as a whole within the farming and ranching community, live with blinders on looking at 12-month blocks. The reality is, yes, we are looking at a particular 12-month block, but when we make decisions, we really need to be looking at the mid and long term as well. And we also need to look at how the decisions we make are going to affect not just one person's tax liability, but everybody that's involved with those farming activities. So just as a reminder, I'm not going to spend too much time on this. I'm not going to go, y'all can read this. Y'all are going to have access to these slides, and so you'll be able to refer to this. But for somebody that is single, this is the 2025 marginal tax rate bracket ranges, and these ranges change from one year to the next. Previous to the Tax Cuts and Jobs Act, the percentage, the rates were a little bit different. That was changed temporarily by Tax Cuts and Jobs Act of 2018. And then the bill that was signed into law back in July made these marginal rates permanent moving forward. The single filing status brackets, this shows you an example of how our marginal tax rates really work. A lot of individuals, they pay taxes for years, but may not fully understand how we actually end up paying or figuring out what our estimated taxable income really is, or the tax liability based on that. And so this works on a sliding scale. So if we have a taxable income of $200,000, what ends up happening is if we take a look and the 10% tax bracket goes from my first dollar to $11,925. I am not married. I have nobody living with me, no children. That means I will pay $1,193 on the first $11,925 of that $200,000. Then you go to the 12% tax bracket. You take $48,475. You subtract $11,926, and that leaves me with a summation, right, of approximately $36,000. You multiply that by 12%, and then you get $4,386. And we go through that until we get to the 32% bracket, which goes from 197 to over 250. But my taxable income is only $200,000. So I take that $200,000, subtract the 197.3, and that gives me, just under $2,700. Multiply that by the 32%. That gives you $864. You add up all those numbers in red on the right side, and that means on a taxable income of $200,000, my income tax liability would be $41,063. This does not take into consideration any capital gains, any self-employment tax that may be owed, or state income tax or anything like that. So now, when I take $41,063 and I divide it by 200,000, which is my taxable income, my effective tax rate becomes just over 20%, 20.5%. That's a big, big difference than that 32%. A lot of people automatically assume I got taxable income of 200,000. I'm in the 32% marginal tax bracket, and there's a lot of people out there that do not understand this concept, and they think I'm paying 32% on 100% of my income. And that's just simply not true. And this is how it works. So this is a good setup with regards to some of the discussions we're going to be moving forward. So to be able to, part of our tax planning strategies are to minimize income tax owed. Now, sometimes that may mean minimizing income tax owed in a particular year, but in other cases, that may mean minimizing the income tax owed over a series of years. And we are kind of doing that long-term planning. And so some of the knee-jerk reaction that people usually look at that are really easy to be able to begin to minimize income tax. And of course, everything has a set of limitations, maximum, minimum limits, and other eligibility requirements. Some of the ones that we typically look at are prepaid expenses, maximizing some different depreciation methodologies, and whether or not we might be able to defer some of that income into future years. And that may be minimizing income in this year, but may create a different taxable issue into next year. Now, we want to be able to attempt to optimize my after-tax income, which is looking back and going, how do I optimize the marginal tax brackets? And we want to be able to review that effective tax rate, which we just ran through. That's why we went through that exercise, so we have that basic understanding, because it's going to be very important that we understand how that works and those marginal brackets, because especially when we get into some of our long-term planning, and we'll talk about that almost towards the very end of today's presentation on a wonderful management method that can really help a number of individuals. So in the long run, my net farm income plus my non-farm income, right, should be greater than, we hope it's greater than, my family living expenses, plus the income tax liability that I owe, and any, we have here land principal payments, but really any and all of my debt payments that I have to pay. Okay? Because if my net farm income and non-farm income is not significantly greater after I have to pay my taxes, etc., then I don't have anything to live off of to buy groceries, and I may not have the money to be able to make my principal payments on my debt. So, a couple of cautionary notes. Equipment purchases should be based on need and not on income tax savings. Do not let the tax tail wag the business dog. So about 10 years ago, because of the way the farm economy was, many of us working with farms saw a lot of people who went, look at all this money that I've made. Even though I do not need a new tractor and a new pickup, I'm going to go and buy one because then I'm going to write it off. Okay? I'm going to write it off through rapid depreciation methodologies and all these other things just to buy new paint that was not necessarily needed. And after 2 or 3 years, we ended up in a major cash flow problem, and some of those individuals may have had to sell land to dig themselves out just to be able to go back and be able to have the money necessary to buy groceries, pay the tax liability on my income, and be able to make any debt payments. So sometimes paying taxes is not a bad thing because that allows me to hold back and hold on to cash so that I can be able to be more flexible, more adaptable when it comes to meeting the needs of the farm in the future and for potential growth. So ag producers have some very unique options for income tax planning that many other mom and pop or family businesses do not. Many tools or options are just not available to many other businesses. So you need to work with those tax professionals before the end of the year, and that's going to be one of the best things that you are able to do. And if your tax professional does not do that, it may be time to seek out a new tax professional. Or see if you can find somebody if where you live, if Cooperative Extension or other groups may offer folks like JC and Ruby or myself out there that work with farms in these types of situations, there may be somebody there that can help you as well. Always leave yourself some wiggle room if possible, and that you can take that from a multitude of meanings. One is don't wait until December 15th or 20 to try to figure out potential tax estimates and then how to be able to plan out. You may not have enough time left in the year to do what is necessary. So I usually tell folks, if I can begin that process and if I can meet with my tax professional before Thanksgiving or at the very latest the first week of December, so I've got a full month to put into action some management plans and strategies, I can do it without being rushed. And I can know it and make sure that it's going to be completed. The other piece of it is looking at that bigger picture to make sure that I have the cash flow necessary to be able to survive without having to go into a high-risk situation of put up additional assets for equity to have to take out potential additional loans to be able to cover my expenses moving into the new year's. Now, sometimes things happen and we have to make some very quick decisions. That's part of life. And if you're into farming, you're into forestry, this is our everyday life. And there are just some things that are routine, weather, other disasters, machinery going down, human issues, illnesses, broken arms, whatever it happens to be, labor problems. And so we just have to be prepared. So again, the earlier that you can get to these things, the better off you're going to be. Okay? So again, Some tools that we're going to be talking about are going to include a multitude of depreciation options, paying for business use items which is, we call it typically prepaid expenses, paying for business use items that are not going to be used until the coming season, okay, into the next calendar year or next tax year. And so we call those prepaid expenses. There are a number of limitations and some very specific eligibility requirements that we are going to be talking about later on in the presentation with regards to that. There are some potential options to defer some reporting of income until the next year. And there's also some things that we can do through installment sale contracts for production, meaning the sale of what I produce and then do an installment sale on those. We're going to talk more in depth on each one of those topics moving forward. And that also includes dealing with the accelerated depreciation. And I believe, JC, this is where you begin to come in.
Okay, so what we get into on our depreciation rules, we have a lot of tools here that allows us to write off depreciation very quickly. And these tools have been around for a while, and we use those when we have an income year that is extremely plush. And we look at this and say, okay, now we have the money to spend to do some improvements of our machinery and equipment. Like we said earlier, make sure it's based upon need, not just tax reduction or avoidance tool. So bonus in section 179 apply, and we'll talk about those. Now, what it does not provide more depreciation, it simply changes the timing of the depreciation deduction. So instead of postponing it over several years, we're taking it all up front. And so the bonus depreciation section 179 rules allows really quick, write it off. Whereas the other types of depreciation, we still get the same amount, but it's simply spread over a period of years. As Adam mentioned, prepaid operating expenses, those things will be used next year. Again, this is great for high income years. Those allow us a trade-off of a current year expense to a later year deduction. So what you end up doing is you're purchasing it this year, you prepay it, going to use it next year, so you pay more, you get a deduction now, and later you probably won't have that deduction there. So it's something to think about. If it's a high income year, this is where it becomes very important to work with your tax preparer, do some estimations of what we're doing this year and where do we think income or farm income will be next year. So what we can do with these is reduce the amount of current year taxable income. All of them will do this. Now we have low income years. We want to use depreciation tools with a slower write-off. So basically you're looking at the maker's type depreciation, which is our standard depreciation tools. And we're wanting to make sure we do not use section 179 or bonus. We're wanting the depreciation to occur later on because the income will probably be higher in future years. Consequently, we're going to need those expense items to reduce that future year income. Installment sale contracts, probably would want to use that. You want to report all the income in the current low income year. There's no sense pushing that income later. Take advantage of it. You're not going to prepay expenses. You're going to deduct those in the current year. So all of these increase the amount of current year taxable income. Therefore, again, we're looking at ways to minimize our overall tax bite over the life of the operation, but we're really trying to maximize after-tax net income over the life of that operation. That's our primary goal. So tax depreciation is just a legal method used to recover the cost of an asset when that asset has a useful life of more than 1 year. Now, the tax rules vary by types of assets and whether or not an item is new. For example, a new combine under the current tax law is allowed to be written off in 5 years, using a 5-year recovery period. So we get to take that new combine and write it off a little quicker if we so desire. If it's a used combine, we're not allowed to use the 5 year. We have to use 7 year. So you have a longer recovery period. So used combine, fences, grain bins all have a useful or a depreciable life of 7 years. That's a 7 year recovery period. Whereas new, you can use 5 year, but you can also elect take it out over 7. So there's some things that we can make elections on. We can manipulate the tax bite. So 179, section 179, referred to both ways, accelerated depreciation. And we have the additional first year depreciation, which is also known as bonus. There's the code sections if your accountant needs to know what those are. But what we're doing, accelerating depreciation, like I said, doesn't provide more depreciation, changes timing. Changes it, current year expense versus a later year deduction. 179 or bonus depreciation, often overused. Especially when we're looking at financed equipment, we may not want to use 179 or bonus depreciation, and here's why. You're taking a large deduction in the year you buy the asset, but the problem is in the future years, that asset hasn't been paid off yet, and the depreciation deduction doesn't match cash flow timing. In other words, we may need to have some of that depreciation expense show up later to offset income, give us a little bit of a break, create some cash flow so we can make that principal and interest payment on that piece of equipment. So the 179 and bonus depreciation, often overused, but we got to think about taking all the deduction now, or do we want it to match the cash flows, the cash outflow associated with paying off that piece of equipment over a period of time? Again, principal and interest payments coming later. Let's talk about the 179 rules. Allows the business to deduct electing cost of qualifying assets in the first year. So what does that mean? Well, you don't have to use the full amount of the cost in the first year. You can pick and choose. I only want to take 179 on 100,000 of a $200,000 combine, or I could deduct the full 200,000 in the first year. There's some other rules that we have to look at. So the qualifying property has to be used in a trader business. That means used in that trader business more than 50% of its use occurring. So if you buy a pickup and you use it for personal use and business use, you've got to look at how much of that pickup use is actually being used for the business. If it's more than 50%, you're allowed to use 179 on that portion. It has to be acquired by a purchase, can't be acquired by a lease. So you have to buy it, put it into service. It's generally going to be 15-year property or less. So that's machinery, equipment, breeding livestock, single-purpose agriculture, horse structures, business vehicles, computer software, office furniture. Those all fit in that. If you're putting together or building a multi-purpose barn, a barn that can house machinery, equipment, store some other items in it, grains, etc., that is a multi-use. It's not a 15-year asset. It's going to be a longer life asset. It doesn't qualify for 179. Now, there's also some depreciation limits. There's a maximum deduction that's allowed. Now, for 2025, this deduction has been increased. So you can actually purchase and place into service $2.5 million of assets and use the 179 depreciation limits if you have enough farm or business income. The investment limit is $4 million. So for each dollar over that investment limit, you reduce the deduction, that $2.5 million, by a dollar. So if you invest more than $6.5 million in equipment or other depreciable items that fall into the 179 rules, if we get to 6.5 million or more, we get no 179 deduction being allowed. So there's some rules there that we've got to watch for. It can't exceed business income. In other words, it can't create a farm loss. It will allow you to offset other income or W-2 wages, but you've got to look at farm business income or non-farm income showing up on Schedule C. There's certain items that's on the Schedule E that's allowed. So when you start looking at the 179, there are some things that we have to consider. Your tax accountant can do this for you when they do the calculations to make sure that we do not, there's a certain portion that we're allowed, and the rest of it gets carried over to future years, not lost, just carried forward. Now, the bonus depreciation rules are a little different. Now, bonus depreciation came along much later. 179 was in 1990. Bonus came about in 2002. Bonus depreciation is again a tool used for depreciation. If you look at this year's rules, it's kind of convoluted a little. So bonus depreciation, we're allowed to deduct up to 100% in the current year, but we got to look at when that asset was acquired and placed into service. It was acquired and placed into service in the first 20 days of 2025. The limit is 40%. So prior to inauguration day, we're only allowed to take 40% of that asset and use bonus depreciation on it. After that date, so after January 20th, and it's placed into service, we can either use 40% or 100%. Beyond that, 2026 and later years, bonus has been made permanent. Now, one thing to keep in mind, even though it says permanent, that does not necessarily mean it will never be changed. Congress or a new president or new rules can be brought into play, and this can be modified at a later date. But at the current time, it's not going to sunset. It's going to be there until some other event triggers a change in those rules. So property that qualifies. So here are multi-purpose structures would qualify, multi-purpose farm buildings. So it just has to be tangible property with a life of 20 years or less. Again, acquired by purchase, not leased. Basically, it's the same general items as 179 plus multi-purpose farm buildings. One of the things to keep in mind, bonus depreciation is default. That's what the tax rules say that you're going to use unless you elect out. And when you elect out, you can elect not to use bonus on all property or just a certain class of assets. So remember, I had a used combine, fences, and grain bin. I can say that I don't want to use bonus on those, but I bought that new combine. It can be used with bonus. So you have some rules and some things that you can do to manipulate or manage taxable income. There's no investment or deduction limits. Bonus can create a business loss. It can offset other forms of income as well. So if you've got wind turbines, solar panels on the farm that you're getting a royalty from, then they can offset that income. It can offset W-2 wages, interest, dividends, etc. Now the 179 versus 168, like I said, 179, you can choose a deduction amount up to the cost of property. Election can be made for individual assets. 168 that's a bonus, all or none for all property within an asset class. So you've got to look at, figure out, play with the numbers. The bonus, it's assumed to be immediately. You have to elect out. 179 has to be elected in. Bonus is allowed for farm shops, machine sheds, etc. Now, those are the fast write-off. Here's some other tools out there that we use. These are what we refer to as the default depreciation rules. This is a modified accelerated cost recovery system, been around quite some time. Basically, it came in the 80s, been some major changes or some changes made to it. But with farm depreciation, the default is roughly 200% declining balance, rapid write-off. I've got a slide that kind of explains or depicts what these things look like over a life of an asset. You elect to use the 150, 150% declining balance if you don't want to use the 200. You can also elect to use the straight line method, which spreads it out even a little bit long, or not necessarily longer, but it smooths the depreciation line. And then the alternate depreciation system allows us to use a straight line over a longer period, which changes or increases the depreciable life of that asset in most situations. So let's look at some of the assets that we're dealing with. Look at ag structures, single purpose, the general depreciation system, the life would be 10 years, but if you use the longer, slower write-off, you can spread it out over 15. Dairy and breeding cattle, 5, normal, 7 if you spread it out longer. let's see, farm machinery, new 5 or 10 years, used 7 or 10 years. So you can kind of see this is from the Farmer's Tax Guide. If you want more information on this, we can send it to you, or you can download the Farmer's Tax Guide from irs.gov and simply search on publication 225. It's downloadable. Now, here's a slide that kind of depicts depreciation methods that we typically deal with. And what I've done, and you'll notice it says 2020, but basically, if you look at 2020 as being year zero, the year we purchase it, we get a certain amount of depreciation. With all of these, we get a half year, no matter what time of year we purchase it. The second year, we get a little more depreciation on all those, and then it starts and once at the bottom. You can see if you use the double declining balance or what we call a 200% declining balance, we get a lot of depreciation in years one or in the year of purchase plus 1, 2, and 3. So 4 years down the road, we're down and depreciating that, and it's going to be at a much lower rate than even what we take off on straight line. Again, what this does is ways of managing, looking at how we're going to affect our taxable income over the life of that having that asset. Now, if we look at a $100,000 tractor purchased in year 2025, we have really 8 ways of dealing with that equipment from the standpoint of depreciation deduction. So you can take off 100% using either bonus or Section 179, or if you slow it down using just regular depreciation methods, the double declining balance over a short time for that new tractor, 20,000, spread it out a little longer, 14,000. So you can kind of see, depending upon how much depreciation or what my taxable income is, I can manage that thing from $100,000 down to the lowest of 5,000. So what does this mean? This tells us we have a tool here that we can then use to manage our taxable income in future years, as well as the year that we will look at purchasing that asset. So again, just a tool to kind of give you an idea of what it looks like under different scenarios. So now, like I said, bonus versus 179, law presumed bonus unless you elect out. You can elect out a bonus on a particular class of assets. Must elect to use 179 on an asset or a group of assets, or you can up to a specific dollar amount up to the investment limit. If we elect out a bonus, decide not to use the 179, then makers is presumed to be used with the 200%, unless we're basically forced to use from, like I said, used machinery, it's going to be 150% declining balance. Amount paid during the current year or for these prepaid farm expenses. So we're looking at 2025, we've got flush income. We're going to prepay these farm expenses. We're going to maneuver our income down a little bit by buying an item that's not going to be used. Buying cattle feed that we know we won't use until 2026, but we're going to pay for it in 2025. In order to do this, it has to be a payment. So we have to actually pay for the feed. It cannot be just a deposit for later delivery. It has to be made for a valid business purpose. It can't materially distort income. Prepaying farm expenses works well in a high income year. We're using this to move income or have a deduction against a large amount of income, and then you pay having those items for use in the future. We have to watch out then for other things that come into play. Constructive receipt, when are we have control of funds? And I'll explain here in a moment where this comes into play. So if something comes into you, you're being paid for something that you sold, and you get paid in December, it's going to be income in 2025. But if there's some way that you can control and not have that check received by you until the following year, then it's deposited in the bank. You don't have control of that. You get to deduct that or include that in income in the following year. So where does this come into play? Basically, when we're selling feed or selling cattle or grains, and we sell it in one year, but we don't get the check until the following year. So you have the ability to control the funds. And if you have that ability to receive a check in the following year, then you have not received it. Therefore, constructive receipt does not occur. Your accountant understands this, but what you want to remember is if we're trying to manipulate or move income, not report income, defer it, we want to make sure that we do not have a constructive receipt of that item. So this works with these deferred payment contracts. It works great for grain. So you're going to sell the grain, deliver it to an elevator, or you're going to sell it to a neighbor or whatever. And you have a contract in place where you do not get paid in the current year, but you get paid. So we don't have the income in the current year. We're going to report the income in a future year, but the grain has been sold. It's now out of our hands. So it has to be a written contract, elevator, sale barn if you're looking at livestock. It has to specify a quantity, price, grade, and time of the payment to be received in the following year. The seller, the farm producer, cannot have a right to receive those proceeds until that date is specified. If there's a right to receive it, constructive receipt comes into play. It's going to be taxable in the year the asset was actually sold. So again, this is a method of taking advantage of a price, but delaying the recognition of income. So these deferred payment contracts work. Be sure to work with your accountant with this. If you need further assistance, this is where Adam and I kind of often will get questions. Is this something I should do, and what do I need to make this work? Also be aware you may have a risk of non-payment because you're maybe dealing with an unsecured creditor. If you're dealing with your neighbor, arm's length contract with the buyer. You as a seller cannot have access to any of that commodity after it is delivered. Can't pull it back. And you have to avoid the constructive receipt. So again, you have to have a date when the income will be reported to you and cannot be stepped up, or you cannot request it to be paid early. So it cannot occur before delivery of the asset. Again, there's an option to elect out. Once you decide to do this, and we look at the situation where we may think that income would be wiser to go ahead and not defer it, all you have to do is report the sale in the current year, even though the payment has not been received. So again, there's a great tool here for managing taxable income, especially when we have uncertainty. And as most farm producers realize, there's nothing more uncertain than farm income. Election can be an all or on a contract by contract basis. So all the commodity are just portions thereof. And again, if you're dealing with the futures contracts, you may want to sell multiple contracts in various amounts. We also may want to do the same thing with these deferred payment contracts. Sell only portions of your grain so that if something goes wrong, or if you need the income to be reported in this year, you can do so without pulling it all back in. Again, deferred payment contracts work very well in a high income year. It does give you some flexibility. Crop insurance. With our crop insurance proceeds, a lot of times we have the ability to defer parts of that. Depends on the crop insurance product. If it's crop damage or destruction, then you probably want to have the ability, if you normally sell more than 50% of that grain in the following year, to defer reporting that income until the following year. Applies to cash basis farmers only. And we're looking at all crop insurance proceeds must be deferred, even if from different crops. Now, revenue policies. So if your crop insurance has a revenue portion, or if it's for revenue purposes only, in other words, you're protecting against a price decline, those revenue policies are based upon revenue and yield. The problem is most of that price change that's not calculated and determined until the year after the crop. Some can't,
Hey,
some
JC,
areas.
we're having some issues with your audio. You may want to turn off your video. I don't know if that will help the connection.
It probably will. I noticed a little bit ago. Okay, there we go. So let's go back to deferral of crop insurance. Like I said, proceeds from crop damage allowed. Normally, if you sell 50% of that grain in the following year, you can do this. Cash basis. Revenue policies have both a revenue and yield loss portion. The revenue portion of that cannot be deferred. Rainfall and weather proceeds cannot be deferred at all. Depending upon where you live or what options you may have, some of that you may look at whether rainfall and weather insurance uh, programs. Section I want to talk about is weather-related sales of livestock. Now, we've done some presentations for farmers.gov on this. There's a lot of good information, but we're just going to really quickly cover this. There's 2 elections that apply when weather conditions lead to sales in excess of normal business practices. The first one applies to market animals or breeding livestock. So either of the 2. Again, only sales in excess of normal. This one requires a federal disaster declaration, and under the new laws, sometimes even a state disaster declaration will be allowed. So what you end up doing here is you're deferring recognition of the gain from those animals sold in excess of normal until the following year. So what normally happens here, you've got drought situations where you've got not enough feed or water. You sell more cattle than normal. Those animals would have normally been sold in the following year. You're then allowed to make an election that you're not going to report that income in 2025. You're going to simply postpone it, report it in 2026, and you file the proper information with the tax return. The other option applies to only breeding livestock, excludes poultry. Again, only sales in excess of normal. This one does not require a federal disaster declaration. All we have to do is show that drought conditions forced the sale of animals in excess of normal. We elect to hold that gain and not tax it until we buy replacement animals. Sometimes those replacements have to be bought within 2 years. Other times, if we get certain conditions extending that, we'll have up to 4 years and possibly even longer if those drought conditions persist. So when the replacement animals are purchased, the basis of those replacements is reduced by the amount of deferred gain from the sales of the original animals. Work with your tax accountant. There's some rules there. The 1033E rules explain this in great detail. There's also a couple of other IRS publications that we'll point out to, and here it is. You refer to IRS notice IR 2025-93 for this year. 49 states were impacted by drought conditions, weather conditions that would then apply to these 2 sets of rules, allowing us to defer reporting of income on sales of excess animals due to weather-related conditions. And another source of income is the drought monitor. And like I said, the information we have on our website, USD or extension USU.edu, ruraltax.org. There's tax topics, a good discussion of the weather-related sales of livestock rules, plus examples, etc. So with that, I want to turn it back to Adam. He is going to then finish off this discussion, starting with income averaging. Adam?
Thank you, JC. And so hopefully everybody can now see my slide set.
It's there.
All right, fantastic. Thank you. So we're going to talk about income averaging. Income averaging has been around for a while. It is available to farmers and commercial fishermen, and sometimes you'll hear some folks refer to the methodology as Schedule J, and Schedule J is actually the IRS tax form that is completed when utilizing this as a tax management strategy. And income averaging is something that you do not have to decide to utilize within the tax year that we are going to file on. And in many cases, this is done at the time of us filing those taxes. However, when we are working with our tax and or legal professional and doing these tax estimates, it is something that ought to be being discussed at that time as well to help us determine and look at the bigger picture, the macro aspect of proper tax management strategies. So sometimes, again, we have a very short period of time here with you today, so we can't go deep into the weeds with a lot of this, but there are a number of terms that you need to understand. And one of the terms is going to be some things with regards to what is the electable income. We have to understand that income averaging can only work with farm income. If you had an off-farm job, it doesn't do anything with your off-farm income or non-farm income. Now, that farm income does not necessarily have to be ordinary income. It could also include capital gain farm income. So we're going to show you a little bit of an example as we explain what income averaging is. In general, we figure out what income can be used for income averaging, and then we have to choose how much of that we would like to average. So if we take a look at, and we're using 2025 in preparation for filing 2025 taxes, if we were to use this 2025 total amount to average, we would take, it has to be equally divided by 3, and we simply apply 1/3 to each of the 3 previous years. The amount of income that I decide to average is known as the elected income. The 3 years prior to the tax year are known as your base years. So for 2025, those base years are 24, 23, and 22. And when we go into 26, those base years will move 1 up. Then your base years will be 25, 24, and 23. And what you are doing is you are not changing the amount of taxable income. You are not changing self-employment tax that may be owed. All you are doing is utilizing unused marginal tax rates from previous years to be applied to a portion of this year's income tax. Okay? This is not the same as amending a prior year's return. Now, for some individuals that have not used income averaging before, and depending on their situation, they may choose to go backwards and amend returns, and then income average from that year to the base years to help create holes. This is going to become a lot more understandable when I bring up an image here in a moment, okay? So you need to understand income averaging is only about those tax rates. The goal is to fill lower unused tax breaks or brackets from the previous years and apply it to this year's income. That's what's happening. Again, it does not impact what you've been subject for self-employment tax. You can elect any amount as elected farm income up to the total amount of the farm income that is reported on your tax forms. Again, if you are a sole proprietor, single member LLC, or filing a Schedule F. That's what we're referring to, the Schedule F, and Form 48 and or Form 4835, etc. This may include any gain from machinery or the sale of cull breeding livestock, milk cows, etc., that were raised on Form 4797, as well as some other farm pass-through income. Wages from farming on if you are a subchapter S corporation, which is required for the greater of 2% shareholder. So that means if you are a shareholder that holds more than 2%, okay, this may include those wages that are required to be paid to that owner operator. Okay, if I sell land, the capital gain on land sales is not eligible for income averaging. However, under the OBBBA that was signed into law, I believe on July 4th of this particular year, there's a whole bunch of caveats. We're not going to go down that pathway, but there is something that may help some of those folks out, and that's left for another webinar or publication at a future date. So I'm a visual person. I need to see things sometimes out on paper and graphed out in images to begin to get a slightly better understanding of what we're talking about. So we're in 2025. We've got a few weeks left before the end of the year, and all of us hopefully are going to be working on development of our tax filings. And so if I was to income average some of my income from 2025, this is what we are beginning with. So if you see that large red marker, that bar, that's 2025 income. 24, 23, and 22 are our base years. And so those are, it looks like, at least here, you can see there's a line that goes from left to right with a little yellow box that says top of the 12% tax bracket. And every year that top of the 12% tax bracket might be a little bit different, okay? And so, and again, we're trying to simplify this just a little bit. But in essence, you can see we did not fill up some of that 12% tax bracket. But this year in 25, we had a good year, and we're way into the 22% income tax bracket. So what we are going to begin to do is we've got 2025 taxable income of about $210,000. In 24, my taxable income was 79. And I apologize. Can everybody hear me all right? I'm not sure what happened, so hopefully I've just reshared. Yeah. Okay, good. I don't know what happened. I just reshared, so we're up. So 2025, 210,000. We're in the 24% tax bracket. Sorry, 22% tax bracket. There's a little bit of an error there. 24, we're in the $79,000 in the 12% tax bracket. 23, we were at 90,000. That would put us into the 22. And in 2022, taxable income of 68.5. Again, we're in the 12% tax bracket. So what we need to do is begin to determine if I want to average my income using some of those lower income tax brackets from previous years and those base years. Is it going to produce a tax savings? And it should. But in some cases, we need to remember it may not produce a tax savings, but as long as it doesn't increase my tax liability, I may still want to use income averaging to create holes so that in future years I can income average backwards. So for 2024, I'm $15,000 below the top of the 12% tax bracket, so I'm going to elect to move about $45,000. We're going to apply $15,000 from each year, and that 24 should be 25, I apologize. So in 25, we're going to take $45,000. We're going to divide it automatically. We have to divide it evenly by 3. That gives us $15,000, and we're going to apply $15,000 to each of my base years, 2024, 2023, and 2022. So what does this mean? My original 25 return would be at $45,000. That would be taxed at the 22% rate. So on that $45,000, out of that total 210, I'm getting taxed $9,900. But what happens if I take 15 and apply it to 12% in my 24 base year, and then I take 15,000 and apply it to 22 and to 22%, which isn't going to change anything, is it? But I have another 15,000 for that third base year out, and that's getting taxed at 12. My total tax liability is going to be $6,900. Okay, so that's going to be a savings of about $3,000 at that point. So we can utilize that $3,000. Now, there's research out there that's pretty old. When that was done about 20 some years ago, when it was done 20 some years ago, they were estimating around $4,000 or just above that, if I remember correctly, of savings for the average farm. I did some back of the napkin using some, making some assumptions. If we were to look at it, now we could be averaging in the $5,000 to $6,000 range or just higher if for the average farm using income averaging. Okay, so it can be utilized in high income years. It can also be used in lower income years as well to create some of those holes. And so we want to create those gaps. So think about yourself if you are an orchard grower, and I just put in some new varieties. I took out an old block. I put in some new ones. I am going to have more income in future years once my trees mature. And so we want to be able to create those holes that I can take some of that income in future years and begin to push it backwards to use those lower tax rates. Okay? So we can also use our pre-tax dollars to lower our tax brackets and to be able to save for the future. So there are some of those opportunities that are available. You need to work with your financial advisor as well as your tax professional in figuring out what would be of value. And those include things like certain retirement accounts, health savings accounts, college savings accounts, etc. What this does is it defers the immediate tax liability to a point in time in the future when that income may be dispersed from, let's say, a retirement account. But that being said, if I put money into a college savings account for my child and that child uses it for college, I'm not going to have to pay taxes on that money if it is used for eligible costs for their college. Okay? Now, you're not allowed to double dip and then also take that off of taxes in that particular year. So we got to be careful on that. There are some limitations with regards to what may be available. You got to keep good records with regards to that. So again, we need to really look at that, and we strongly encourage every farmer ought to be building some retirement funds, and it's just something that we need to get used to. So some of those retirement plan contributions may include the traditional IRA contribution. And so this requires you have to have earned income to be able to contribute to this. This is done pre-tax. Maximum contribution of $7,000 per individual for 2025. If you're 50 years or older, you're allowed one additional $1,000 as a catch-up. That maximum contribution may be limited if you or your spouse participate in other qualified retirement plans. Again, work with a financial advisor as well as your tax professional. Plans may be established as late as the actual tax filing deadline. So even if my tax year has ended, I still have up to my tax filing deadline, April 15th in most cases, to be able to put money into that, which will save some tax liability. Again, some of these contributions we can also deal with utilizing my traditional IRAs, SEPs, simple retirement accounts and 401ks, and use some rollover conversions as tax management strategies. So in good years, in high tax years, I may move money into traditional IRAs and 401ks, etc. And then when I have a bad year and have little income and I'm in a lower income tax bracket, I may be able to move my money from some of those traditional IRAs and simple accounts and 401ks, etc., and then pay the taxes on the value being rolled over into, let's say, a Roth IRA. That Roth IRA then is allowed to grow, and when I remove money out of that, since I've already paid the taxes on it, I am not going to have to pay taxes on any of the principal value in that when it is removed. This allows for a tax-free growth, limiting my tax liability into future years. Lots of rules on this and what counts, what doesn't count, and everything else, and whether or not individual eligibility. There may be some questions with regards to that, so please seek out professional financial advisors and tax advisors you're familiar with to help you through that particular process. Again, some basic things here. Simplified employee pensions may be available. We're not going to cover a lot of this, but you will see this. Because of time, this has some basic information that you can review when we send this out or you're provided access to it. We'll make some quick changes to a couple of the errors that we found in there so that it is correct before Janet and Sarah put this out for everybody. Okay, so we wanted to make sure that some of that information is out there. You can also use that health savings account. That is a wonderful opportunity to be able to use some pre-tax money and lower some of my potential tax liability within a particular year. So taxes paid as you go. If no or low withholding, you may need to make some estimated tax payments during the year. This starts getting into a few other things. Qualified farmers are not subject to underpayment penalties. So now this begins to discuss who has to pay taxes on a quarterly basis, or can I hold back and utilize some other rules? And so we'll leave this information here. Some of this information can also be found in a couple of other publications like Pub 225, as well as a couple of other publications that we have on ruraltax.org. All right, here's a couple of other resources. And again, you'll be able to have access to that. And with this, there's, if you got additional questions or thoughts or need to contact somebody, please contact Miss Janet Wright at janet.wright@usda.gov, and she'll figure out who the right person is for a question and or access to some additional information, and she will get that to us. All right, I'm going to stop sharing my screen. And I know, Sarah, there were a number of questions that came up. Would you like us to, JC and I, to attempt to answer any of those?
Yeah, I think so. It would be good. I know JC has typed some answers into here, but I think it might be good to go over some of these for folks. Let's see. Okay, so here's a good one, and Adam, I'd be curious about your perspective. One of the questions was, what are the most common mistakes you see producers make when reporting farm income or expenses?
So that really varies based on the producers themselves. So one of the things that I see, especially for younger or newer folks getting started into agriculture, is not understanding that every time I have to pay somebody something, that whether or not that item that I am purchasing that I had to pay for is actually a deductible cash expense, or does it fall into a capital asset purchase? And so how that has to flow through your accounting, into your accounting reports, and its effect on tax and tax liability, whether or not something needs to be depreciated, that's a pretty common error. The other one that I find is surrounding livestock, in particular cattle. And so when I have and I am raising breeding animals or milking animals like milk cows, we have to be very careful on whether I'm purchasing something, an animal to come into the herd, how that's not necessarily a deductible expense, but that's actually a capital asset purchase. When I begin to cull animals, was it an animal that was raised versus an animal that was purchased? And so all the tax implications, that can get very complicated, versus even purchasing an animal I'm going to feed out and sell. So that's one thing. The second is improper usage of depreciation. People like to go crazy with it, and it gets them into trouble in the long term. I'm not a big fan of the high limits that we see on things like Section 179 and bonus depreciation, because I believe that it actually develops improper or bad habits. So those are just a few of the things that I typically see.
Thanks. Let's see. There are a couple of questions in here about construction costs, and can you depreciate total cost of construction, including hired labor? And somebody asked also if a driveway improvement would be an eligible farm expense on the Schedule F.
Okay, so let's talk about the building first. So in fact, what you are supposed to do, and in fact, even if I've got my own labor that I hire that helps, that might be full-time workers and they're in the field harvesting or helping me plant. But technically, even when I have them begin to build a building on my property that is an asset used in a trade or business, like a barn, technically, I am required to kind of pull out the value of the wages that were used, that I paid as they were building that building. And I have to take all of that, along with all of the input costs associated with that building, and those are not deductible cash expenses. Those all get totaled up into the actual cost of that building, and once the construction of that building is completed, it then gets put onto the depreciation schedule and it will get depreciated out. Okay? And so then I have to follow those capital asset rules and depreciation rules from there. That may be a little bit more of an oversimplification, but generally that's what takes place. When it comes to the driveway improvement, there's a lot of ifs, ands, or buts as it relates to that. We would need a little bit more information about what are we talking about in improvement. Am I putting in a brand new driveway? Well, then that's an improvement to the property. That's going to be depreciable expense. Now, there's all these other little rules that I might be able to deduct it as a cash expense under very specific scenarios. But that is it. And so we really need to get a little bit more information about that and discuss, is it something that can be deducted as a cash expense, where it seems to be more of a repair. I had 2 or 3 potholes and I spent a few $100s to patch that. That's probably going to be repair, deductible expense, versus putting in a whole new driveway. Am I extending the life or changing the purpose of the item? Typically, if I answer yes to those, it may begin to indicate that it may be a more capital asset or an asset improvement that may have to be depreciated. But none of those are 100% foolproof.
Anything to think about on that driveway, is it strictly for farm use? If there's a personal residence on that, you really got to pay attention to what portion and work to figure out how much of it's personal and how much of it would be allowed for the farm business. And that calculation will take a little bit of time.
That
It
very
won't be
good
fully
point.
deductible.
Yep, very good point.
Thanks, Adam.
What else?
And there were a couple questions that came in. I think it would probably be good to just talk about If your farm didn't make any money or you dissolve your LLC, start and maybe end a farm operation even in the same year, what should you do with your taxes?
When I answered that, Sarah, you've really got to look at, so to dissolve the LLC, that still means they've got a farm. They're going to file a farm even though they didn't have the income. They're allowed to file that Schedule F with a loss. The issues really got to think about is they're trying to get rid of the LLC. That EIN will still be there. It probably will never go away, even though they wrote a letter. The real thing they've got to look at, and it would be wise to get with a tax accountant, go through the correct procedure to file that return as a sole proprietor, not use the LLC information, but use their own taxpayer identification number and file the return accordingly. That way, again, it will create a loss, but at least they've got things reported correctly. It gives them a place to start from that forward. There was
I
one question
concur.
there about an inherited operation, and I was getting ready to look at that. Well, I don't remember what the question was fully.
So I think, JC, is this the one you're referring to? Husband and his brother, along with the wives, have inherited the family farm. The estate is still being settled, but I've been volunteered to do the bookkeeping. What can I do now to begin to learn farm tax laws in Iowa for when the estate is completely settled? We're planning on turning it into an LLC as soon as we can. So the Iowa Center for,
Center of Ag Law and Taxation,
thank you,
CALT.
CALT, C-A-L-T, has a number of programs, publications, etc. The director is Christine Tidgren, wonderful individual. I would start looking there and reviewing as many of those publications as you can. Go to ruraltax.org. We have a wonderful small and medium-sized farm tax guide or tax publication, and it covers a lot of information. Do that. And the other thing I would consider for assistance is call up Mr. Kent Vickers at the Iowa Farm Business Management Association as well. And I would strongly encourage you to become a member of that particular association, especially with the situation that you have just described. It will be extremely beneficial and get you started on the right foot.
Thanks, Adam. And looks like we have cleared the Q&A queue, folks. So if you've got any last questions, drop them in. And if not, thank you for joining us. And just a reminder, it will take us a couple weeks, but we will get this recording captioned and posted online, and you will receive, you'll be able to access the materials on farmers.gov/taxes.
Fantastic. Thank you, everybody.
Have a good one. Bye.
Thank you.